Hey there, I'm Lynn Toomey, and today I'm joined by Brian Saranovitz of Your Retirement Advisor. Welcome, Brian.
Hello, and thanks for having me.
You're welcome. Today we're talking about Brian's portfolio risk optimization concept. So, Brian, can you tell me what this concept is all about?
Well, one thing that I learned early on when I was, of course, teaching retirement planning to pre-retirees is a mathematical equation that basically is backed by research. And that mathematical equation goes like this. The portfolio with the lower risk level or volatility level will last longer when taking withdrawals for income, all other factors being equal. Once again, the lower risk portfolio when taking withdrawals will last longer, all other factors being equal. So if you have two portfolios in retirement, which is very important because you are taking those withdrawals, so if you have two portfolios, one gives you a 6% return, the other gives you a 6% return. So both equal in their return percentages historically, but one offers double the amount of risk or volatility level. Here, the other offers this amount of risk and volatility, half that amount of volatility. Your portfolio will last longer in retirement with the lower risk portfolio. So that's what my HIP strategy, hybrid income portfolio strategy, is all about. It's about creating a portfolio mix, maybe an unconventional portfolio mix of assets that will reduce the volatility and risk, which is good so you're not pulling your hair out, as well as we're seeing now the market's down 20%. This HIP strategy is down about 6%. So it's about creating a portfolio, and that's what the HIP strategy does, is it creates a portfolio that dramatically mitigates risk, yet still gets that 6-7% return as a conventional portfolio, but with far less risk, as I said.
So, Brian, you've been talking about the concept of portfolio risk optimization. I've heard you mention it in your classes, and I know you talk to clients about it and students. So can you go into a little bit more deeper about how the risk part of that concept plays out in your hybrid income portfolio strategy?
Well, first of all, portfolio risk optimization is a term that I've kind of put together. And what I look at is portfolio risk optimization is combining certain asset classes in different types of investment products, both insurance and investment, to get the highest return possible with the least amount of risk. So really what it's doing is it's wringing out the risk and giving you the highest return for the risk that you are assuming across the gamut. And I think that's exactly why I call it portfolio risk optimization, because you're optimizing your return for the risk you are assuming. So that's really what it is, and that's why I've developed the HIP strategy that I just talked about briefly. And it's a hybrid because it incorporates both traditional stock and bond investing on the investment side of things, and on the other side of it, it incorporates the best of what an insurance product can do, give you guaranteed annuities. So when you combine those two together, statistically, it gives us the best risk return strategy. That's what the HIP does, and that's why I call it portfolio risk optimization, which is, as I said, based upon the math, that mathematical equation, don't want to say it again, but based upon that mathematical equation, we need to reduce risk and get the highest return possible when in retirement taking withdrawals.
Okay. So in comparison to, say, a conventional 60-40 stock bond portfolio, how does the HIP compare to that? And I didn't hear you mention bonds in your HIP. Yeah. So what happens to the bonds?
Yeah, it's like back in the day. I'm sure if baby boomers are watching this, where's the beef? Yeah. And that's exactly why I look at my HIP strategy versus a conventional. It's a conventional 60-40 strategy. And ultimately, the HIP strategy, first you asked, how does it compare? it compares very favorably, because what you're going to do is you're going to potentially incrementally, with my HIP strategy, above a 60-40 or traditional investment stock and bond strategy in today's marketplace, you're going to potentially increase return and decrease risk in about half. And so ultimately, that bodes very well for a retirement portfolio. Once again, increasing return, decreasing risk is very good in retirement. You also asked me what happens to the bonds in the portfolio. Well, we all know, and I've been teaching retirement planning for many years now, in many different strategies in retirement planning. And you asked what happens to the bonds in my HIP strategy. Well, for the most part, they're gone. For the most part, they're gone. As we've seen this year, year to date, Bloomberg aggregate bond index and most bond funds are down anywhere from 10 to 15%. As interest rates go up, understand, bonds lose value. And I've been preaching this for years. And ultimately, we've seen the last 3 years, bond funds have given us no return or negative return. So to put 40 or 50% of your portfolio in retirement in a bond fund or a bond right now is not the thing to do. So my HIP strategy basically takes those bonds out and replaces them with what I feel are, and what some of my clients actually call their super bonds. And these are structured investments, structured notes that are designed to reduce downside risk,
like
loss, like a bond,
okay.
And also FIAs, fixed index annuities. FIAs are guaranteed against market loss, and these guarantees are backed by the financial claims paying ability of the issuing insurance company. And let's put that into context with bonds, why I don't like bonds. At a 3% yield of the 10-year Treasury right now, the next 5-10 years, most big investment management firms are saying they feel bonds are going to be looking at about a 2 to 3% return the next 5 or 10 years, if we're lucky. Mm-hmm. So I'll take 5 to 7 with less risk over 2 to 3 with more risk in a bond all day.
Yeah,
and that's the super bond component to the HIP strategy.
So Brian, I'd like to review for the audience the structure of the HIP. So what is it composed of? You're not replacing stocks because you have to have stocks in your portfolio. Yep. And then we've got structured investments and FIAs in some kind of combination.
Yes.
And I'm assuming that the combination of those three elements are dependent upon each person's situation.
Each person's situation, each person's goals, and each person's risk tolerance or risk level that they can tolerate. So for instance, the HIP strategy is made up of an aggressive component to the portfolio, which I consider that to be global stocks, global stock funds. And then the middle portion, which is moderate, are those structured investments, structured notes, structured investments minus 10%. And then the conservative side, so you get A plus B plus C. Now, everybody is not going to fit one particular HIP strategy. If you're more conservative, you may be in a 30-40 strategy, which is 30% global stocks for inflation protection, 30% in the structured notes, which gives you an upside potential, but minus 10% downside, kind of moderate risk. And then the third side of the FIAs, which are going to give you a little bit less upside than a structured note. So you get A plus B plus C. So some people that are more conservative may be in a 30-30-40. 30% global stocks, 30% notes, moderate, and 30% FIA, ultra conservative. Other people that are a little bit more aggressive may be in a 50-25-25, where 50% is in global stocks, aggressive, 25% is in the moderate notes, and then 25% is in the ultra conservative FIAs. Or you could even be in a 60-20-20, which is even more aggressive. So everybody's combination of HIP is going to be different. Everybody's combination is going to be different based upon the retirement outcome that we run through, because we run a retirement stress test across many different market environments to see which one works best for each individual. But then it also entails looking at an individual risk tolerance. We may say 50, 25, 25 looks really good, but people have said to me, no, Brian, I would not want to put 50% of my money in the market. So then we may go back down to a 40, 30, 30 or a 30, 30, 40. So it all depends on individual risk tolerance, and it also depends on the outcome that we're looking to obtain within their retirement projections.
So Brian, hybrid income portfolio, you've got me interested. You're uniquely positioned to offer it because it integrates investments and insurance. So why doesn't every advisor out there, financial planner, offer a hybrid income portfolio-like solution?
Yeah, like the HIP strategy. And I think one of the reasons is because of bias. I think bias. When you look at the typical registered investment advisor, what they are is they utilize stocks and bonds in a portfolio. They're not licensed to offer annuities and insurance potential solutions in a program. So in many instances, they're either one of two things: biased towards annuities or ignorant to annuities. And both aren't good for a retiree. So ultimately, a lot of times, what I find is when you go to a registered investment advisor or someone that is a stock bond only advisor, they will say and hold the company line and say, annuities are bad. They're overpriced, sold by insurance salesmen. And
Complicated.
Complicated. They're this, that, the other thing. Yeah. Exactly. Annuities and structured investments can be complicated, but when understood and integrated properly, they can give you a potentially risk-protected outcome. So that's A. That's the investment conglomerate. Now the insurance conglomerate on the other side, they, in many instances, don't have a securities license and don't have the ability to utilize stocks and bonds in a portfolio. So their only benefit and their only solution, I should say, is annuities and life insurance. So they're going to say, wow, be careful. You could lose all your money in one day in the stock market. It's dangerous. You should have everything guaranteed income, guaranteed principal protection. And that's just as bad as the other conglomerate. So ultimately, what you need is somebody that can offer both sides of the equation and truly understands how they integrate together to give a better outcome. So as I said, you've got both sides battling for the money because of their bias and, in many instances, ignorance of the other side. And what is necessary is that integration of the two properly so that you get a potentially lower risk level and a potentially higher growth rate.
Sounds good to me. So if I wanted you to do a portfolio stress test of my portfolio, I'm preparing for retirement. I don't know how many years before retirement you recommend someone do this stress test to find out, how do I transition my 60-40 stock bond portfolio? What do I need to do? How do I take advantage of this retirement stress test? And importantly, when do I do it?
Yeah, well, I would say, you've got, I've heard before the retirement red zone, 5-10 years before retirement. So I would say if you're 10 years before you're going to retire, 5 years before you're going to retire, or just recently retired, that's the time to get together and to talk. Because what I do is I run a stress test that looks at a number of different market environments, a negative market environment. So let's say today we're in another 2000 to 2010 where the market lost 1% for 10 years, called the lost decade. We don't know if that's where we're at right now. We could be in a negative sequence for the first 10 years from this point forward. That's a negative sequence. So what would happen to your retirement if you're 5 or 10 years from retirement and that occurred today, and then you're planning to retire in 5 or 10 years and you're in that lost decade? That's a negative sequence. And or if you're just retiring, what would the outcome be? So we have a stress test that we will run against that negative environment, but we'll also run it against the great market environment moving forward the next 10 years, just like we've had the last 10 years, other than this year. So we'll run that stress test to see what portfolio mix Whether it's a traditional 60-40 or one of the HIP strategies, we run a number of portfolio makeups with your stuff, Social Security, pension income, in your portfolio and how it's currently allocated. And we'll look at how can a HIP potentially better your situation in your outcome over the years in a projection looking at a negative, positive, and an average market scenario. So we can determine what portfolio mix is best for you.
That sounds great.
Yeah.
So before we close out this conversation, I know you have something called multidiscipline retirement strategies, or MDRS. So I know that the minimizing volatility is one of the most important strategies you talk about, but I know that there's a few others that are important for people to consider. So it's not just about transitioning your portfolio to this portfolio risk optimized one that you call hybrid income portfolio, but there's a few other strategies that I think it's important for people to hear about as we close out this conversation.
Yeah, well, like you said, I call them the multi-disciplined retirement strategies, MDRS. And they're strategies that can put you in a better light moving forward in retirement.
Potentially.
Can give you potentially a better retirement outcome. Potentially a better retirement outcome. And those strategies are portfolio risk optimization, which is the HIP strategy. Okay. Absolutely one of the strategies that should be employed. Another one is tax mitigation, retirement tax mitigation, through whether it's Roth conversions or whatever it is. But there's a huge benefit to tax planning in retirement. It can potentially add another 8 to 10 years of retirement life to your retirement portfolio by reducing and mitigating taxes. So tax planning is very important, in which I do for my clients. And then we also have, how do you use home equity? A lot of people have $300,000, $400,000, $500,000, $600,000, $700,000 in their home value. How can you potentially, doesn't mean that everybody has to do it, but how can you potentially learn about strategies to integrate with the rest of the portfolio, the tax planning, the PRO? How can you integrate home equity to increase your outcome, to get a better potential outcome as well? And Social Security, timing is another MDRS strategy that potentially can put you in a better overall and give you a better overall outcome in retirement as well. So
those income strategies sound amazing, multidiscipline retirement strategies. It sounds like your retirement advisor, when they work with someone, you take time to educate people about those strategies and then potentially integrate those strategies into a cohesive plan for them. And we don't have time in this conversation to talk about the protection side, but that is another important priority and aspect of retirement planning.
Even doing that, putting all that together, then of course there's long-term care risk mitigation. And that includes incorporating estate planning and long-term care planning. Even though we incorporate all of the MDRS strategies to get an individual, a retiree, the best potential retirement outcome, a long-term care event can crush the entire plan, That's why we also utilize specialists in that particular area for each and every client. Looking at long-term care, looking at estate planning, trusts, wills, so on and so forth, to make sure that we mitigate that risk as well when in retirement. Because we've all seen friends, parents, grandparents that have ended up with Alzheimer's or other debilitating illnesses. And ultimately, it can really wreak havoc if not planned properly. So that's just another piece of the equation that must, not should, but that at least must be addressed, at least be addressed.
Yeah, and I know there's a healthcare part of it too, so that's a whole nother video.
And that's a whole nother, that's a whole nother video. That's, when you're talking about Medicare, Medicare issues and so on and so forth. But we also have specialists in Medicare that help our clients through that maze, which is something I do not want to talk about because it is extremely complex, and that's why we have specialists in that particular area to help our clients through that Medicare maze.
Well, I guess my point of bringing all this up is to reinforce the fact that your retirement advisor is not that traditional investment advisor where you go and just grow your money and they're just managing your portfolio. It's truly a complete A to Z retirement planning company that focuses on making sure or doing the best you can to make sure people don't run out of money in retirement, helping people figure out when they can retire. That's a big question, right? Would you say that's the biggest concern?
Yeah, I think two things when people first come and talk to me is they ask me, with everything I have, and I don't care if this is someone that has $5 million in their assets, in their investments, or if they have $250,000 in their investments. The first thing people ask me is, one, when can I retire? And number two is, how much can I get from my retirement? And that's why, once again, those two, making sure my portfolio lasts a lifetime. And of course, that's why those two questions are paramount to success, because once again, when you have, and I said this earlier, an efficient retirement using the MDRS, all the MDRS strategies in your overall solution, it can potentially either increase the amount of income that you can take from your portfolio and put in your pocket and have a better retirement, or you can leave more money to your loved ones down the other end. So efficiency simply means that you can take more money and enjoy a better lifestyle in retirement, or you can, in fact, leave more money on to your loved ones. And that's very important. And I think that's what people want to know. But like you said, the two paramount questions I get all the time is, when can I retire? And make sure that my money lasts me till I'm 90, 95, 100. Yeah. Very, very important. That's the question that people are really fearful and worried about and concerned.
Yeah, to me, you are like the risk mitigator. There's so many risks that retirees face, and it all comes down to how much risk are you willing to assume, and if you can find a partner and a team that can help you mitigate those risks with the right retirement strategies. So, Brian, if someone wants to take advantage of a chat with you, I know you're always willing to chat with people, or do that portfolio stress test because they have some immediate concerns of, I am in a 60-40 stock bond portfolio and I see what's happening to my bonds. What can I do now? I know that you can go to virtualchatwithbrian.com, schedule a time, get on your calendar, and get that assessment done. Brian, thank you so much for chatting today about your hybrid income portfolio, your multidiscipline retirement strategies, and your retirement advisor. Thank you.
Yep, so the last thing I will say is be hip in retirement. All right, I thought I had to get that one in. All right, thank you, everybody. Thank you, Lynn. Thank you, everybody. Appreciate being here.
Securities are offered through Securities America, member of FINRA and SIPC. Investment advisory services are offered through Securities America Advisors and are separately owned and other entities and/or marketing names. Products or services referenced here are independent of SAI and SAA. This information is not intended to be a substitute for specific individual tax, legal, or investment planning advice, as individual situations will vary. Investing involves risks, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining values. Securities America and its representatives do not provide tax, legal, or Social Security advice. Therefore, it is important to coordinate with your tax or legal advisor regarding your specific situation.